and welcome to the March edition of the Hoffman Private Wealth Group podcast. I'm Todd Hoffman, Certified Portfolio Manager and Certified Financial Planner, and the founder and Managing Director at the Hoffman Private Wealth Group at Stewart Partners. Thank you for joining us.
Yes, welcome to our March update. I'm Jenna Macris. I'm a wealth advisor on the Hoffman Private Wealth Group, and I hope your year is off to a good start so far. We have a podcast full of useful information today, and we are sure you will enjoy it and find it helpful and informative. Todd, let's get right into it. The markets have already been crazy, and now over the weekend, we have new military conflict. Maybe you can comment on what is happening in the Mideast.
Things escalated quickly this weekend with direct military strikes on Iran from both the U.S. and Israel. This included the killing of the Ayatollah Ali Khamenei, the supreme leader of Iran, along with his top generals and most of the senior security and military leaders. Iran has a deep bench, and it's striking back, sending missiles and suicide drones into Israel, the U.S. bases, and the neighboring countries. So far, it has also shut down the Strait of Hormuz, a key shipping route where about 20% of the world's oil passes through, and it goes mostly to Russia and Asia. So this isn't just a political tension anymore. It has real life and death consequences and significant economic impact.
How have the markets reacted?
Well, this isn't the first international issue this year, but as you would expect, investors are nervous. And according to Reuters, news from the market open today, it looks like oil prices were going to jump around 10%. And gold and safe haven investments are currently rising. And the U.S. and global stock markets were down, but not at catastrophic levels. And further, prices seem to be firming up already this morning as we're starting this podcast. The concern isn't just about the conflict. It's the risk that oil and natural gas supply could be disrupted for long enough to disrupt the markets.
And why does this matter for the economy?
If oil stays at elevated levels, it can push inflation higher again. Plus, because many nations rely on cheap oil from Iran, such as Russia and China, tensions are high. For the U.S., it could make goods and transportation more expensive, and it could slow progress on bringing inflation down, potentially delaying interest rate cuts, and it could deepen the tension between nations. So this could impact the broader economy, not just the energy markets.
Can you give us some ideas of what you're looking for?
It really comes down to how long this lasts, and if things calm down quickly, the markets will stabilize and likely go significantly higher. If disruptions continue, we could see ongoing pressure from higher energy costs and more market volatility. Since all this just escalated over the weekend, we're going to need to have some patience here to see what happens over the next week or two. History tells us not to panic, and that making financial decisions is generally a mistake when you're panicking, and it can negatively impact your long-term goals. My plan is to be vigilant, but only make changes if absolutely necessary.
So it's been a busy start to the year, but not a smooth one. Besides the issues in the Middle East, what else are you watching?
Well, under the surface, markets have been changing leadership. The macro backdrop remains supportive, and recent data from the Bureau of Economic Analysis and the Bureau of Labor Statistics continue to show that the economy growth is holding up, and that labor markets are stabilizing, and that inflation is gradually cooling. So the foundation is solid. But what's happening in the markets right now is that it's not about the economy weakening. It's about how investors are reassessing where future growth will come from.
So what's driving that reassessment?
AI is reshaping how investors think about business models. For the past decade, markets rewarded asset-light companies, especially software firms, with subscription revenue. But the AI race is turning out to be extremely capital intensive. And based on company disclosures from Alphabet, Amazon, Meta, Microsoft, and Oracle, projected AI-related capital spending now exceeds $600 billion in 2026. That's roughly 2% of the U.S. GDP. And importantly, this no longer looks temporary. According to facts, equity markets have responded to this increased expenses and reduced free cash flow by compressing forward valuation and multiples in parts of the growth sector.
Has that changed what the market outlook is and what might be the future winners?
Yes, the AI lens is quickly changing from what companies AI is going to disrupt to what companies AI is going to enable a competitive advantage. For example, some software firms are now facing a real question. If AI can replicate part of what software can do, and do paying customers still need to pay for all the software subscriptions that they needed before AI? Meanwhile, companies tied to physical systems are benefiting. Bloomberg sector data shows improving relative performance in areas like industrials and logistics and infrastructure. And that makes sense. AI can write code, but it can't operate rail networks or build supply chains, and physical assets are harder to disrupt.
So is this the end of the AI story?
Absolutely not. In fact, AI is already delivering measurable productivity gains. Company commentary compiled by FactSet increasingly is highlighting improvements such as faster production cycles and better inventory management, higher efficiency in logistics. And retailers are also seeing higher orders assisted by AI tools. Manufacturers are improving output with shorter lead times. Energy firms are optimizing operations in exploration, transportation, and distribution. So while parts of software may feel pressure, the broader economy is benefiting.
So outside of AI, what else is helping?
There's several supportive trends. And recent releases from BEA and BLS show job growth stabilization after last year's slowdown, and inflation is continuing to moderate, and fiscal policy remains supportive. But these positive trends together, many consumer forecasts are still pointing towards GDP growth of around 3% this year. That's a very healthy environment.
How are you responding to all of these changes and the recent switch in what has been working?
So we've trimmed some of our past winners, and even though many remain strong companies, we've needed to free up capital for what I believe is the next market leaders. That can feel counterintuitive, especially when it may trigger capital gains taxes. But holding a position to simply avoid taxes can become a costly mistake if it prevents capital from being deployed into better opportunities. Taxes matter, but opportunity cost matters more. Last year was a good example. According to JP Morgan, only two of the Magnificent Seven, Google and Amazon, kept pace with the S&P 500. The rest underperformed. These are still great businesses, and we continue to own most of them, but leadership changes over time. The goal isn't to sell good companies, it's to avoid letting yesterday's crowd out tomorrow's winners. And paying some tax today can be the price of maintaining flexibility and staying aligned with where growth in the market leadership is going to next. In many cases, the long-term return from reallocating these new opportunities can outweigh the short-term tax of trimming. This is not about abandoning quality. It's about actively managing capital to keep portfolios positioned for the next phase of growth. So 4 guys walk into a bar: a market strategist, a Fed watcher, and a long-term investor, along with a portfolio manager. The economist says, "I know where the market's headed." The trader says, "I can profit from the move." And the long-term investor says, "Wake me up in 10 years. But the portfolio manager says, "Let's make sure we're still holding the right winners when you wake up."
Funny one, you slipped in a joke there.
We are staying diversified, but we're leaning into areas where there's earnings visibility and it's improving, and valuations are reasonable, and economic sensitivity works in our favor. This includes dividend-paying companies, industrials, cyclicals, and small caps. And we've also been adding to both developed and emerging international markets. We've seen last year's dollar devaluation continue in 2026. And assuming the Middle East situation doesn't change this, and it shouldn't, any weakness in the next couple of weeks could prove to be great buying opportunities.
Now, can we switch to what now already seems like old news? The recent Supreme Court ruling saying that many of the tariffs put in place last year were done so without authority?
The administration is already at work trying to mitigate damage from this ruling. And it's announced across the board 15% tariff rates under Section 122 of the 1974 Trade Act. Further, the White House is working with trade partners to modestly adjust the deals negotiated last year using the new 15% tariff rate. While uncertainty creates short-term volatility, the overall impact of the economy, inflation, and corporate profits is likely to be muted, at least for the next 150 days, until this authority expires. So this will be an area we'll need to continue to monitor throughout the year.
So how about bonds?
Bonds have been quite stable, and recent reports from the Wall Street Journal and Bloomberg suggest that municipal supply continues to be absorbed, and this has been supportive of prices. And yields remain attractive, both for taxable and municipal bonds, and credit spreads are still tight. The bonds in our portfolios continue to provide very attractive income compared to many alternatives, as well as they help to add diversification, which helps reduce volatility.
Now, there's been some noise in private credit recently.
That's true, but based on public reporting from CNBC and Bloomberg, the private credit issues reporting appear to be isolated to a small number of managers, and broader conditions appear to remain stable at this time. I've reached out to several of the credit managers we work with, and they remain bullish and feel the press has overblown some of these concerns. And having said this, I will continue to monitor that this problem doesn't turn into a systemic risk.
Now, what is your current outlook on interest rate cuts?
Everyone keeps asking when rates are going to be cut. At this point, it kind of feels like we're waiting for a table at a busy restaurant, and you're told it'll be soon, but no one's making any promises. I still expect one quarter point percentage rate cut before mid-year, and another 1/4% cut before later in the year. Plus, in addition to these 2 rate cuts this year, I believe that the incoming Fed chair, Kevin Warst, will add other forms of quantitative easing, and this is going to support the economic growth and stability. If the events in the Middle East should alter this current Goldilocks scenario of not too hot and not too cold, this should become evident in the next few weeks. However, I have a lot of confidence that these events in the Middle East are going to play out pretty quickly.
So, Todd, what is your big takeaway?
Watching the Olympics this month has been a good reminder that even gold medalists stumble. The key is, don't walk off the ice after one shaky landing. Markets work the same way, and unfortunately, volatility is part of the routine. The recent volatility, and the likelihood of more in the coming weeks, is normal, and it's a normal part of behavior, not a reason to panic. According to FactSet, even in strong market years, it's typical to experience at least 2 corrections per year. So far, this year appears to be following that pattern. And remember, the market remains only a few percentage points below its all-time highs. And while market drops are never as fun as market advances, this isn't our first rodeo. The economy is strong, and we're always seeking new opportunities to fine-tune portfolios to capture the next big wave of gains. At the Hoffman Private Wealth Group, we help high net worth families, executives, business owners, and physicians to navigate shifts with discipline and clarity.
Thank you for listening to the March edition of the Hoffman Private Wealth Group podcast. If you find this helpful, please share it with someone who may benefit from a thoughtful perspective on today's markets.